Hey everyone, 𝐻𝐸𝐴 accountant here, and I wanted to jump on and do a video. And this video is going to be about investments and taxes, and it's going to be a quick, informative video letting you guys know once you get into investing and you're investing in different areas, what that means for you tax-wise, and is this income that you're generating from investing, how is it going to be taxed? And so you're going to hear terms like long-term capital gains, long-term losses, depending on the type of investing you're doing. So I want to start off with what is a capital asset, and we'll get into what a capital asset is, and then I'll talk about how different gains and losses are taxed. And so a capital asset, to begin, is basically an asset that you own for investment or personal purposes, such as real estate, stocks, bonds, stamp collections, stuff like that. Those are all considered capital assets. And it's basically the asset that you hold. So the asset that you purchase, that you are holding for a certain period of time, that you want to generate a gain from. And so some terms that you want to be familiar with is when you purchase it, it's going to be generating at a cost or a basis. So what does it cost for you to actually get hold of this asset? And so that's going to be your purchase cost or your basis. When you sell this asset, so somebody buys it from you and takes it off of your hands, you now have proceeds from that sale. And so that cash is actually the proceeds from the sale. And so when you are now going to do the formula of what your proceeds less your cost is, that's going to give you your gain or your loss. So depending on if the proceeds are higher than what you paid for it, which is what most people want to do, you are going to have a gain. And in some instances, when you sell something, you sell the capital asset and you sell it for less than you actually purchased it for, you're going to have a loss. Short-term versus long-term is now going to depend on how long you actually held this asset. And so if you held it for longer than 12 months, you fall into the long-term category. And if you hold it for less than 12 months, you're going to fall into the short-term category. So for real estate, for example, if we're talking flippers, if we're talking wholesalers, you guys are going to tend to fall into the short-term category because you guys aren't holding on to these capital assets, these assets for longer than 12 months. Whereas our buy and holds, our rental properties, those are going to be considered long-term because they're purchasing the asset to hold on to it. And so the purpose of their investments is for long-term purposes. And so they're going to have different tax treatments. And so that's what I'm going to get into now. So if we look at these, you're going to see a bunch of charts. And so I'm going to try to talk through them. So if we look at these tax rates for 2019, because we're in the 2019 tax filing year, I'll show you the 2020 tax rates for the 2020 filing year that's going to start for next year. So ordinary income, short-term capital gains, ordinary dividends, they're all going to fall into what we call these ordinary income tax rates. And so think of ordinary income tax rates as what you're used to if you're coming from the W-2 world. So what are your earnings taxed at? And so you see that the rates are going to go from 10 to 37%. It was reduced with the tax reform that happened back in 2017 from about 40% to 37%. So that was a good thing. And so you guys can see the income levels here. And so it's going to basically be telling you if you make this amount, between this amount and this amount, you're going to fall into this tax rate. And it's going to give you the different categories. So if you're single, you're married, you're head of household, so you have dependents under yourself and your house, or married filing separately. So these are going to be what you fall into. And like I said, if you are having capital gains and they're short term, you're going to fall into this category. So your traders, if you're doing trading of stock investment and you're not holding these trades for long term, you're going to fall into here, and those gains that you make are going to be taxed as ordinary income. And we can see here that this is the 2020 rates. So what they basically did here, the rates stay the same, but the income levels were increased in most of those instances. So you just have higher income that you can make that you're going to be taxed at the same level if you compare it to the prior year. So those are the short-term capital gains as well as ordinary income and ordinary dividends. So now we go into what is considered long-term capital gains. And long-term capital gains and qualified dividends, those are dividends that you receive from companies you have ownership in, but they're treated differently for tax purposes. You can see here the tax rates, there's only 3 levels, and they are drastically different from what you saw from the earned income, the ordinary income side. And so you have 0%, 15%, or 20%. And so here you can see that the majority of people are going to fall into the 15% category. So your earnings from these long-term capital gains are going to be taxed at 15%. And so it's stated that the long-term capital gains have, more preferential tax treatment than earned income. And you can see here that that is the case. And so these are the 2019 rates and the 2020 rates. The rates stay the same. It's just the income levels that were actually changed. And so you can see here that there's a drastic difference. If you are making $441,000 in long-term capital gains, you would be taxed at the 15% if you were single. Whereas if you were making that the same 441 for a single and it was like earned income, you would be taxed at the 35%. So that would be a 20% increase in what you would be taxed. And so I hope this quick video shows you guys the difference of what the tax rates are, ordinary income tax rates versus the long-term capital gains tax rates. And essentially what is going to make you fall into one bucket or another is going to be how long you actually hold the assets. And so I said that this is actually not going to be a video that's going to tell you which one is best. However, you can do the math and you can see that the long term has more peripheral tax treatment. So I hope this video was informative. You guys can leave comments at the bottom of this video and let me know your thoughts. I just wanted to jump on really quickly and let you guys know how your investment earnings are actually going to be taxed. So I hope you enjoyed. Again, I'm Tia, the Savvy Accountant, and I'm happy to answer any questions you guys may have. Thanks.